Hello, my name is Brenton Harrison with Ultra Borrowers Academy, an online course where we help people with a mountain of student loan debt take back control of their loan process and make sure that it's just one part of a full financial picture. Today, we're here to talk to you about home buying when it comes to student loans. This is a topic where many of you may be in a position where you're considering purchasing your first home, but you have student loan debt and you're wondering how will those loans impact the home buying process. So we have a quick video for you today on some of the rules and regulations when it comes to student loans. And typically you don't see any uniform standard. It typically varies from lender to lender, but we wanted to give you some principles and some concepts so that you know how your lender might approach it and whether or not that means you should look for a different one or whether you should make some changes to your student loan to make sure that you're eligible or to make sure that you get the best rate and best terms for your home loan as you can. So let's get into it. Student loans and home buying. It's important to know and important to understand the two elements of the home buying process when it comes to the application that determine the interest rate for which you'll be approved or not approved, and also what determines how much home you can purchase. So the first part that determines the interest rate that you'll receive on your home loan is your credit score. Now, I won't give you a definitive credit score that you have to buy a loan. I'm recording this in the age of COVID-19. You're actually starting to see lenders rapidly increase the minimum credit score that's needed for loans. And we don't know if that's something that will be temporary or for a long term. So we're going to avoid saying the minimum credit score that you need, but instead we'll talk about the process of finding your credit score. If you apply on your own for a home loan and you do not have a co-applicant or a co-borrower, then what will happen is they will pull your credit report or your credit score from the three major bureaus, TransUnion, Equifax, and Experian. And what most companies will do is they will throw out the highest and the lowest score, and they'll use the score right in the middle. So if you have an 800 with Experian and you have maybe a 600 with another lender, and you have a 700 with the third, then they're going to use that 700 that falls right in the middle. If you're applying with a co-applicant, they'll do that same process for your individual score, but then they'll also look at the credit score of your co-applicant, and they will use the lower of the two scores when determining the interest rate for which you'll be offered. Now, that means that if that person that you're applying with hasn't had good credit, maybe they don't have a minimum credit score needed to qualify for the loan, then not only can they not be on the application, but they also cannot have their income included when determining how much home you can purchase. And that feeds into the next section, which is your debt to income ratio. Pretty much everybody's familiar with the concept of a credit score, but you may not be familiar with the concept of a debt to income ratio. The debt to income ratio determines how much home you can purchase. And there's two parts that your lender is going to look at. You're going to look at your front end debt to income ratio and your back end debt to income ratio. So let's discover what those mean. All of this is important because when you have student loans, it's pretty easy to understand what your payment is in terms of its relation to your mortgage application if you have what's called a standard loan plan. A standard loan plan is wherever you pay is based off of the amount needed to pay your debt off in full within a given period of time. If you have a 10-year standard plan or a 20-year standard plan, your payment is designed to pay off those loans, principal and interest, in full within 20 years. Well, it's a little different if you're on the type of plan called an income-driven plan, because under these plans, you pay based off a percentage of your income, or your discretionary income to be exact. And it has no connection at all to your loan balance. And what that also means in relation to what goes on your home application is that you could have a loan payment that you're making towards an income-driven plan that in no way is enough to cover the principal and interest of your actual loan payment, meaning you're not paying enough to pay it off in full within a given period of time. Now, that can be problematic when it comes to the home loan and when it comes to calculating your debt to income ratio. Debt to income ratio in its entirety is a system where a lender looks at your monthly income and they get a representation of how much of your monthly debts swallow up that income, and that's called your debt to income ratio. The overarching formula for it is if you take your monthly income and you divide your monthly debt payments, you'll find your debt to income ratio. Now, the reason that this is the process that determines how much home you can be approved for is because your lender wants to make sure that you're not overextending yourself. So if they look at your debt to income ratio and it's too high, then they're wondering, if we add on this home payment, are we going to put them in a position where they can't pay us back first? They are gracious in some cases, but at the end of the day, they want to make sure that they can get the money for their loan. So if you have a debt to income ratio that is too high, it is an indicator that you will have some trouble paying back a home loan. So this is something that they use to determine how much further can we go in terms of giving them additional financing through a home payment. Now, there's two forms of debt to income ratio. The first is your front end debt to income ratio, and that is simply your housing costs divided by your monthly income. Now, I said we're not going to put any numbers on there because this is going to vary from lender to lender, but a good rule of thumb is that your front end debt to income ratio doesn't need to be more than a third. It doesn't need to be more than about 33% of what you're bringing in on a monthly basis. So if your housing costs can't exceed more than 33% of your monthly income, and that's income before taxes, it's worth knowing, what are they considering that housing payment? Well, if you have a mortgage, they're going to look at your new mortgage and they're going to say that the housing costs include the principal of the home loan payment, the interest of the home loan payment, your homeowner's insurance, your property taxes that are owed on that property, and if you have any homeowners association fees, those are also included in the cost for your housing payment when determining your front end debt to income ratio. So regardless of your back end debt to income ratio, if you're buying a home where the home cost, the housing payment that you're making is more than about a third of what you bring in, you could put yourself in a position where you can't get approved for that much financing. You would have to find a house that costs less, or you would have to find a bigger down payment to put down on that property to drive down the home loan payment. The second form of debt to income ratio is called your back end debt to income ratio. And your back end debt to income ratio takes all of your debt payments and divides it by your monthly income. So that would be a student loan, it would be a credit card, it would be an auto loan, it would be any form of debt that you have. And if it's a minimum monthly payment, that's where they're going to put into the formula. And for that, again, the standards may vary, but a good rule of thumb is that you need to have a back end debt to income ratio of less than 50% to be approved for most conventional loans. Again, that can change based on the type of loan that you're purchasing. So on the front end, you want to make sure that your housing costs do not exceed 33% of your income. And on the back end, you want to make sure that your housing costs don't exceed, all of your debt payments don't exceed 50% of your monthly income. Now, all of this ties back to student loans because with income-driven plans, if you are lucky, you'll be working with a lender who will allow you to use your income-driven plan when calculating your back-end debt-to-income ratio to determine whether or not you can be approved for a home loan. But unfortunately, there are many conventional, quote-unquote, old-school lenders who will not allow you to use the income-driven payment that you're making when it comes to calculating your back-end debt-to-income ratio. And there are different formulas that different lenders use, but one of the two most popular ones that you'll use in terms of, hey, what are they going to put in that calculation? It's called the 1% rule. And the 1% rule is when you have federal student loans that you're paying back under an income-driven plan, instead of using that payment, your lender will instead take 1% of your loan balance and insert that as the monthly payment for your debt-to-income calculation. I have an example for you here. If you have a $300,000 student loan balance, then even if you're paying $50 a month towards your loan, your lender is going to take 1% of that balance, in this case, $3,000, and that's what they're going to insert as the monthly payment for your student loans. Now that can be extremely problematic because on paper, using your income-driven plan, you may be well within the boundaries of the debt-to-income ratio requirements. But with this calculation, where they take 1% of the loan balance, you might find that your debt-to-income ratio is too high to be approved, and you wouldn't be accessed financing or granted access to financing for that property. This is the 1% rule. The next is what's called a standard payment calculation. So we've talked about standard loans. The payment that you make is designed to pay off the balance in full within that given period of time. And what happens with the standard payment calculation is they would calculate the standard payment that would be needed over this period of time and insert that in the calculation. We have an example here, a $300,000 loan at 5% interest, and a person might be making an income-driven payment of $500 a month, but if you do the standard payment calculation, they would be paying almost $2,000 a month. So in this case, the person would not be able to get financing because the standard payment calculation is too high to be eligible for this home loan. So what does this mean for you if you're looking for a home and you have student loans? Well, the first thing is it adds a question onto the list of things that you should be asking of potential lenders when you're applying or before you're applying for a home loan. If I were in a position where I thought that my lender or potential lender may not accept an income-driven payment for my student loans, I would want to call their customer service line. I would want to talk to one of their representatives to ask that question before I risked having my student loans pulled or my credit pulled with a lender that I know is not going to be able to offer me financing. That's on the negative side. But on the positive side, it means that if you do find lenders who will allow you to use your income-driven payment plans, or if you're applying for a particular type of loan that allows you to use those payment plans, such as the physician loan, which is a particular type of loan for physicians, dentists, that allow them to have that income-driven payment calculated in that payment for the debt-to-income ratio, then that's a positive. It gives you the opportunity to manipulate your payment in a way where the lower you can get that required payment, the more home you might be able to be eligible for when it comes time to look for your house. I hope all of this was helpful for you and it provides some clarity and some context to the home buying process when it comes to student loans. If you have any questions, you're welcome to reach out to us to tell us about videos that you want to see in the future or to apply for our course and take our course. You can go to ultraborrowers.com and we'd be happy to take you from there. I'll see you next time. Bye.